I'm pleased to introduce Mr. Anton Vorobets.
Thank you, Johannes. I'm the founder of a company called Fortitude Technologies that develop software for institutional investors. I personally have a traditional finance and economics background that I supplemented with some machine learning courses while I was working full time. So I started my career on the sell side, working with equity derivative strategies. And basically there I quickly realized that the theories for, the investment theories that I learned at universities were not that useful to get the insights that we wanted. So the stuff I learned about stochastic differential equations and derivatives pricing and things like that, it's actually okay because it gave me some practically useful insights. But anything related to KBM, Black Leaderman, and mean variance, I very, very quickly realized that it wasn't good for getting us the practical insights that we wanted. After a year with equity derivative strategies, I switched to the buy side, doing multi-asset investment management and portfolio construction. And here again, these observations that I had just became even more clear to me because we were always talking about what will happen in the left tails of our portfolio's return distributions and how are the dependencies there. And there it was clear for us that this mean variance framework is just not able to handle that in a meaningful way. So that's why I started developing a different approach while I was working at Danske Bank Asset Management. So basically, early versions of the methods that we propose now have been used successfully by myself to manage billion-dollar multi-asset portfolios that include derivative, leverage, and complex constraints. For the past 4.5 years, I have been working on developing and distributing production quality versions of this investment framework to institutional investors. So in total, I have about 10 years of full-time experience working with investment markets and technology.
Awesome. So we can just kick off with the first question here. So when it comes to portfolio construction, what are some of the myths or misconceptions you see professionals fall into, and how do you usually tackle them?
Yeah, I think the biggest one is believing that mean variance is sufficient for good portfolio construction and arguing that they don't want to make things, too complex. And while I believe that it's true that we should not make things more complex than necessary, we also want to avoid some gross oversimplifications that fundamentally disagree with core characteristic of investment markets. So I think the approach should be more in the spirit of the famous Einstein quote, where he said that we should make things as simple as possible, but not simpler. So when you think about these traditional academic methods, such as KBM and Black Leaderman and mean variance, they fall into the simpler category. So they are overly simplified for practical beneficial use. So the suggestion I always give is to focus on generating joint paths for investment markets instead of just estimating covariance matrices, and then ensure that the methods that you use for analyzing and stress testing these paths, they actually operate directly on the path simulations. Because if we focus just on estimating these means and covariance matrices, we already reduce the market to an elliptical distribution, such as the normal distribution or the z-distribution. And if we just do some simple empirical analysis, we can very clearly reject the hypothesis that markets follow these distributions. So the point is that if you use this elliptical distribution assumption, I would say that you are wrong by construction, where there's like practically zero probability that you will be approximately correct in your risk modeling, which I think is the best that we can hope for with the investment markets. So another issue I see is that somehow people, they believe that they can perform better than their competitors by using more or less the same technologies. So basically, and what is available commonly even to mom and pop investors. So basically that if they just use mean variance, Black Leaderman, and things like that, which is widely and easily available, then somehow they expect a different outcome than their competitors. And I would say that that is logically inconsistent. And if we actually look at firms that are known for having very, very good performance, then you see that actually they care a lot about doing something differently. So if you hear interviews with, let's say, Jim Simmons or Rentec's current CEO, then it quickly becomes clear that they do not really care about what others are doing, but rather they try to figure out what they think makes sense and then go and implement that in the markets. I would also say another example is with some of these very successful trading firms, where most quant firms, they use C++ and object-oriented design, but then somehow some of these very successful firms, they use a fairly unknown functional programming language. So it's another example of people looking into what actually makes sense instead of what the rest of the market is doing, because this is necessary if you are really serious about outperforming.
No, that makes sense. And I assume when it comes to portfolio construction that it's also very easy to overcomplicate things because you're trying not to be too simple, not to simplify too much, but you can also risk kind of overcomplicate it. So how do you balance keeping it manageable but also keeping it robust?
Yeah, I think it really comes down to this: if you overfit or no. So that's the most important point. That if the method that you have, even if it's very very complex, if it generalizes to live out of sample performance, then that's good. If somehow you have a method that is complex and overfit, then there's a big issue. While of course also if you have a method which is so simple that it underfits, then also you cannot expect good performance. So I would just say that it's about finding this trade-off where you get things just right and good generalized performance. And I would say with mean variance, KPM, Black Leatherman, things like this, you're probably more in the underfitting area, compared to overfitting.
Okay, awesome. So going more into the kind of advice for younger quants. So are there any skills, technical or conceptual, that you notice people often underestimate but are really crucial in practice?
Yeah, so my best advice is to focus on studying mathematics, statistics, probability, and computation, and then apply these skills to solve real world problems. And by that, I mean that you actually look at what is the problem and then you try to solve that and not some wishful oversimplification of the problem. And it's also, I generally find that mathematicians are better at remaining scientific because they are trained in strict logic. So if there are any logical inconsistencies in their conclusions, then mathematicians generally are better at identifying them than people who, for example, study finance and economics. Because if you carefully think about many of these mainstream finance economics theories, you will see that there are many logical inconsistencies and assumptions that are not grounded in reality. So basically, to accept that, you have to be willing to accept some kind of university indoctrination, not to point out, these logical issues and disagreement with empirical testing. However, I would also say that I have also seen some mathematicians that somehow became anti-scientific through time. So it does not mean just because you have a mathematical background that your scientific approach is always on point. But I think it's a shame that, and it's not a strategy that I recommend for people who truly want to be successful in investment management. And one clear example is you see with Rentec, which arguably is the quant fund that specifically somehow decided not to hire people from traditional finance economics background and have a tremendous performance.
Awesome. No, it's actually very insightful. But now looking forward, like say 5 to 10 years from now, where do you see portfolio construction and risk management heading?
Yeah, so I think that there will be much more focus on path simulations and then stress testing, analysis, and optimization methods that operate directly on these paths so that they work no matter how complex the simulations are. And this is the investment framework that we work with. And the current state of technology actually allows us to solve these problems in a efficient way. But of course, the implementation of these methods and, both in practice in terms of technologies and algorithms, it's of course much harder than just estimating covariance matrices and doing invariance. So there is this trade-off. I also believe that more people will start to use what I call a quantamental approach to investment management. And one of the examples is that recently we have seen some traditional quant funds now starting to open discretionary strategies. And I think basically this comes from the fact that it can be very, very hard to outperform these large markets with a lot of AUM in a fully systematic way. Just to summarize, I think there will be more focus on methods that combine data analysis with human discretion in a thorough and a consistent manner. And then, one example being the sequential entropy pooling method, which is very powerful for predictive views and stress testing of fully general Monte Carlo distributions.
Okay, yeah, and then kind of following up on that, I know that's quite a talking point at the moment is generative AI and everything surrounding it. And I was wondering what your take is on how that might shape or if it might have an effect on the landscape moving forward.
I think it will, but I think that we are still in the very, very early days of how we use generative machine learning methods for investment market simulation. I think this is one of the very, very interesting areas that you can work in. And there's potential for us to improve quite significantly compared to the current methods.
Okay, no, awesome. So, a question I'm interested to hear your take on is how do you personally approach portfolio construction when you need to factor in ESG or other non-financial constraints?
Yeah, so things like ESG are still handled in a discretionary manner, to a large extent. And I think it's okay whenever measurement is complex or close to impossible. But I think that wherever we can, ESG metrics such as, let's say, CO2 emissions, they should be included directly in the portfolio optimization constraints, similar to just exposure constraints and leverage constraints and whichever other constraints you have, because actually you can add this as a metric, relative to the exposures, that you have. And as I said before, in general, I think that most people have the highest probability of being successful with this quantamental approach. But I still think that the foundation of an investment process should be data-driven, where maybe it can take you something like 75 or 90% of the way, while you then allow for discretionary adjustments, in the remaining part of the risk budget, and just incorporate nuances that are hard to measure, or let's say some triggers that we have not seen historically before, which you can incorporate in a discretionary way. Because fully systematic investing, it sounds cool, where you just lean back and let the computer do the work. But anyone who has actually worked with systematic investing in a successful way knows that it's not how reality is. Systematic strategies need to be constantly tracked to assess if the alpha is still there. And I think also that a lot of discretion goes into which kind of hypotheses and strategies are actually tested when they are designed.
Okay, awesome. Yeah, no, so moving over to a bit more of a programming side. So I checked out your Python frameworks. It looks seriously cool. But my question is just how do you balance making them flexible enough for experimentation while keeping them stable for real world institutional use?
Yeah, so first of all, thank you. But the open source software that we have, it's actually only 2 to 3% of the easy work. So the intention is that they should give people an introduction to better methods than Black Leaderman and invariance, but it's not recommended to use for institutional investment management. At least it's not built for that. Because we have subscription solutions for institutional investment managers that are much more stable, have elegant interfaces, and then allow for very, very effective analysis of complex investment problems. So this open source software is also used in the accompanied code to mine scientific articles and this portfolio construction and risk management book. So it allows you to really explore basic cases of SIVA optimization, entropy pooling, and derivatives portfolios. So yeah, I highly recommend that people check it out. So that as an alternative to the academic methods. But this is just coming back to your question. If in order to keep these subscription solutions flexible so they can be used for experimentation, we generally encourage people to use, high-level code in the way that they want. So historically, many of these institutional solutions, they have been focused on a point-and-click interface. But my experience is just that this average user does not really exist. So, everybody wants to do something slightly different. And I think that high-level code allows people to do that. So that's actually one of the areas that we get positive feedback on the things that we do. And also, it seems to me that Python is basically becoming the new Excel. So in the old days, everybody should be able to use Excel if they work in investment management. Now it's turned towards Python, while some people, of course, try to combine it with Excel also still.
Okay, I know. And just quickly on the notes of your book, I also saw on your LinkedIn a post about it. Can you just quickly give me a rundown of what that consists of?
So this book basically presents this investment framework that we work with in a coherent way from start to finish, so that you have an idea of how all these methods they play together. So yeah, that's because we shared many articles describing different elements, but we just realized that having this big overview, it was hard for people, and of course there are also many new methods introduced in this book, specifically when it comes to portfolio optimization with parameter uncertainty and rebalancing tests and things like that. So there are things that are unique to the book, but otherwise it's a more coherent presentation of the investment framework and its methods.
Okay, awesome. Yeah, no, speaking of methods and bit of bringing a bit of machine learning into it. So, which machine learning techniques and risk management do you think deserve more attention than they're currently getting?
Yes. So as we talked about before, just this generative modeling of investment time series, I think not enough time is spent on that. So that's like applying time series variation autoencoders in GANs to tabular time series data. I think there's a lot of potential for these methods. And actually, I think that in the same way that we have large language models, which we call LLMs, in the future, probably we'll have something like large market models, which we can call LMMs. So basically, where we can perform investment market simulation of very, very high dimensional markets. So currently, the problem of generating text or images and investment time series, they are fundamentally different. And unfortunately, current machine learning frameworks are not really built for tabular time series and handling the state and all these things. So they are quite complicated just to get the fundamentals right before you can start experimenting with the generative machine learning. And of course, there's also the issue that we often have a lot less investment data than, for instance, text or images. But I think that there's potential for a lot of transfer learning. So, for example, that we can learn something about US implied volatility and interest rate dynamics by also having access to European implied volatilities and interest rates. So basically, specifically about the possible shapes of the volatility surfaces and interest rate curves, and potentially learning some no arbitrage conditions and things like this. Because while the levels they differ, the relative values and dynamics can be quite similar across markets. So, for example, in most equity derivatives markets, you have an implied volatility skew. So, this is a characteristic that you can have more observations on if you combine data from multiple markets into your generative machine learning method. So I think that is how we can overcome some of the data issues that we might have in investment time series.
Awesome. And then just on a practical note, so how do you decide which quantitative method to use for particular market problems? So do you have like a framework for making the choice?
I would say that first and foremost, I focus on the method's ability to handle, the actual complexity that you're trying to solve. So, the important nuances of the investment markets that you work with. So if I can already at the beginning decide that a method is oversimplified and I cannot provide very, very strong justification for this particular oversimplification in the sense that I can argue that it will somehow still give good results, then I completely discard the method. Full stop. Because I think that using an oversimplified model just because it's easy to use or it's tractable and then hoping that it will work in reality is wishful thinking. So I always try to avoid that. So yeah, in summary, I focus on methods that in principle can handle the full complexity of the problem. And of course, these methods might not be easy to estimate or calibrate, but it's probably necessary complexity that we must be willing to accept, yeah, to maximize the probability of being successful in practice.
Okay, no, awesome. So that's all the questions that I prepared for today. So if you have any other comments that you would like to make on anything, then you're open to do so.
Yeah, no, I would say that I think it's great that you have this interview and that you are sharing these insights with people who are trying to enter the quant space, because I think most people they think that if they want to work with investment management, they should study finance and economics. This is what I did, what I thought, and this is the field that I came into. And I would say I quickly learned that probably it's a better way to study mathematics, computation, and practical data methods compared to many of these finance economics theories. Because I think what I learned the most, especially in this macro finance, is not to take these methods and models seriously. Because if you just study mathematics, you don't know it, and you start going into the field, initially you probably trust that these are good models, that people are writing about them. But as soon as you start to examine them from an empirical perspective, then you see that quickly they fail, because it's basically it's not a priority. Many of these methods are very theoretical in nature and with no testing. Yeah.
Okay, I know, awesome. So I think there's quite a few aspiring quants who would watch this. So maybe just a quick word of advice to aspiring quants from your side.
Yeah, I would say that try to not look so much at what other people are doing. Try to focus on what you think makes sense. What's the problem, and then make your own decision on how you want to, yeah, pursue your investment strategy, because you have to do something differently than the majority if you want to be better. It's just if you want to beat the market, it's a zero-sum game. So if you make a good trade, somebody else made a bad trade on the other side. If you do long-term investment management, I think it's different, because let's say somebody buys a stock and they just hold it for long, then you can collect dividends and it can increase in value. People win like they're more over time. But if you want this where you actually have investment alpha, you have to do something different, and you have to always ask, how is my approach different than the market, and why do I expect that to give a better performance, yeah, and not just a different performance.
Awesome. Yeah, no, so I think that's all for today. But thank you very much, Mr. Vorobets. It was a pleasure having you and having you share your knowledge.
Thank you.